What are the arbitrage funds? Is it possible to lose money invested in them? Asks Jayashree.
So far, arbitrage funds haven't lost money, but mutual funds are subject to market risk. One should not forget it ever. But so far, in last 15 years, they haven't. They are designed in a manner that you don't lose money. The way it works is the fund invests in equity and a corresponding derivative. So it is like a buy and sell. So if there is a security, assuming the share of a company X is trading at 100 rupee and the future contract of that share is trading at 110 rupee. So and these kind of opportunity keeps arising in the market on a day-to-day basis. One has to be a little alert about it. And that is what these funds do. So what this fund will do is buy this stock and sell the future. And in a month's time, he will pocket the gain of 10 rupee. And normally the return, this kind of arbitrage, they don't tend to generate extraordinary return. They tend to generate almost like liquid fund return or ultra short-term bond fund returns. The difference is that because our tax structure is such that it is investing in equity as well as equity derivatives, so the tax treatment is like that of an equity fund. Tax treatment of equity fund is that 10% long-term capital gains. If you derive the same return from a fixed deposit, or if you derive the same return from a fixed income fund, fixed deposit, it will be at marginal rate. Even from bond funds, it will be taxed at your marginal rate. It will be added to your income and it will be taxed at 30% or 20% or 10%. In this case, being equity, it will be treated as short-term capital gains and 15%.
Okay. So the tax advantage?
Short-term capital gains, 15% for less than 1 year investment. More than 1 year investment, 10%, as it will be treated as long-term capital gains.